What if I told you that most losing trades aren't because your strategy is bad, but because it's incomplete? Welcome to the Propfirm Ask Channel, where precision meets confirmation and every trade starts to make sense. You've probably heard of SMA, you've likely used Fibonacci, and Trendlines. Almost every trader draws them, but how you combine them, that's the edge. No one teaches properly. This isn't some watered-down strategy based on one indicator and hope. This is an advanced system that aligns market structure, momentum, and key price zones to tell you exactly when to enter, when to sit out, and how to ride trends with confidence. In this full course, I'll walk you step by step through the exact settings you need on your chart, how to stack confluence between SMA, Fib levels, and trendlines, and, most importantly, how to avoid fake breakouts that kill your trades. But before we go deeper, let me ask you something. Have you ever entered a trade at a Fibonacci retracement just to watch price slice right through it? Have you ever drawn trend lines only to get confused whether they're valid or just wishful thinking? Have you ever relied on moving averages, but still got shaken out by volatility? Then this strategy was made specifically for you. The mistake most traders make is they treat these tools like isolated signals, but real edge comes when they talk to each other, when they align like pieces of a puzzle, and when they do, the accuracy goes from 50% guesswork to nearly sniper-level precision. Let me be clear, this isn't about perfection. This is about stacking probability. This is about confluence, not prediction. Because in trading, the more signals that agree, the more confident you can be. Throughout this course, I'll show you why SMA zones are more powerful than single lines, how Fibonacci retracements act like magnets only when the structure supports demand, why most trend lines you see online are flat out wrong. Well, break down what makes a valid level versus a trap. You'll see real examples of losing trades and why they failed, plus how this strategy would have changed the outcome. It's not about hindsight, it's about recognizing real-time structure and knowing when to act. You'll also learn the exact entry conditions I use, where to place your stop loss with logic, and how to manage trades like a pro, whether you're scalping crypto, day trading forex, or swing trading stocks. This strategy adapts, whether the market is trending, consolidating, or whipsawing. The SMA-Fibonacci-Trendline combo filters out the noise. It's like having a built-in lie detector for fake setups. And if you've ever felt overwhelmed by indicators, don't worry. We'll simplify everything down to a few key rules that you can apply immediately, even if your chart looks like chaos right now. If you stay until the end, I'll even break down a real trade I took using this exact system, showing you how all three tools lined up perfectly. You'll see the setup, the entry, the exit, and most importantly, why it worked. So, get your charts ready. This isn't just a strategy. This is a framework for thinking like a pro trader. Let's dive into the foundation first, and understand why most traders are using these tools wrong from the very beginning. Foundation recap. Before we can unlock the full power of this system, we need to make sure we're speaking the same language. Let's break down the three tools that make this strategy work: SMA, Fibonacci retracement, and trendlines. You may know each one individually, but you've probably never thought about how they interact in real time. First, SMA's simple moving average. The simple moving average is one of the oldest and most reliable tools in trading. It shows the average price of a security over a set number of periods, like the 50, 100, or 200 SMA. But here's the catch. Most traders use SMAs as signals, not zones. And that's the problem. SMAs are not exact lines. They are zones of potential reaction. Treating them like lasers will lead you to premature exits or missed entries. Smart traders don't just look at the SMA line. They look at the behavior around the line. For example, the 50 SMA is often used to track momentum, If price pulls back to the 50 and bounces, it suggests continuation, but the 200 SMA acts more like a macro support or resistance. It shows deeper trend bias. Also, pay attention to SMA slope. A flat SMA is a sign of indecision. A steep one indicates trend strength. Combining the slope and interaction with price gives you better insight than just watching for crosses. Here's something else. When multiple SMAs compress into a tight band, you're often looking at a high volatility breakout zone. Most beginners ignore this setup, but pros watch it closely. It's the calm before the storm. Second, Fibonacci retracement. Now let's talk about the most misunderstood tool in trading: Fibonacci levels. You've seen the famous 61.8% retracement line. You've probably heard it's a golden zone to buy. But how often has price ignored it completely? That's because Fibonacci only works when it aligns with structure. If you just slap it onto a chart without understanding swing highs and lows, you're gambling, not trading. The most important levels for this strategy are 38.2% shallow, pullbacks and strong trends 50%. Not a true Fibonacci number, but widely respected 61.8%. The golden zone, 78.6% deeper corrections before reversals. Fibonacci retracements work best when drawn after a strong move, not during a choppy range. If the move before the retracement isn't impulsive, the fib levels lose meaning. And don't forget extensions. A fib extension at 161.8%, lining up with a projected trend line, is often a profit target magnet. We use fib retracement not to predict exact reversal points, but to identify potential zones where price might react. If there's confirmation. That's why we never trade fib in isolation. We wait for the trend line or SMA zone to agree. That's what gives it weight. Third, trendliness. Now onto trendlines, possibly the most abused tool in the trader's toolbox. People draw lines that fit their bias. They bend trend lines just to make them look valid. But if you want to trade with precision, you need rules. A valid trend line must have at least a clear touche point speed, drawn from obvious swing highs or lows, not minor candles. Avoid cutting through wicks or bodies excessively. Also, trend lines work better when combined with time. The longer a trend line holds, the more powerful its break or bounce. And here's something most traders miss. The angle of your trend line tells you about momentum. A steep trend line often breaks faster. A shallow one indicates a healthy, sustainable trend. Even more powerful when a trend line and an SMA cross at the same time at a fib level. That's what we call a triple confluence setup, and those are gold. Another bonus tip: in strong uptrends, trend lines drawn underneath price are more reliable. In downtrends, use upper resistance trend lines. Avoid crossing through the body of the price action. Why these tools fail alone? Of these tools can work, but they're unreliable on their own. SMA alone, you'll get late signals or false exits in chop. Fibonacci alone, you'll catch random levels that mean nothing. Trend lines alone, you'll believe every pullback is a setup. The problem is randomness. Without confirmation from a second or third tool, it's easy to fall for traps. Market makers know most retail traders use the same basic levels and they'll engineer fakeouts right around them. The real power comes when all three agree. Imagine a price pulling back to the pro 61.8% Fibonacci level, right where it touches the 50 SMA and bounces off a clean trend line. That's confluence. That's what separates pros from hopeful amateurs. But if even one of these elements is out of place, say the SMA is flat or price is below structure, you wait. No guessing, no hoping. In this system, we wait for the market to come to us. Mental reframe: think of these tools like filters. Each one reduces noise. The SMA filters trend direction. Fibonacci filters correction zones. Trendlines filter momentum paths. When all filters agree, you have a high probability zone, not a guarantee, but a real edge. And remember, confluence is cumulative, even if all three don't align perfectly. 2 strong confirmations are often enough. If paired with candlestick validation or key support zones, this strategy is about removing randomness from your process. You don't need a dozen indicators. You just need 3 tools, perfectly aligned, and yes, sometimes you'll wait longer for a trade to appear. But when it does, you'll feel calm, certain, and clear. No more hesitation or second guessing. Now that you understand how these 3 tools function individually and where they fall short, we're ready to start putting them together. Let's begin by preparing your chart with the exact layout that'll make spotting these setups effortless. Setting up the chart before you even think about placing a trade. Your chart setup needs to be clean, clear, and built for decision-making, not decoration. Here's exactly how to configure your chart so you can spot SMA setups instantly, without second guessing. Step 1. Platform setup. Use Trading Viewer. Using Trading View because it's clean, customizable, and gives you all the tools you need in one place. If you're using MetaTrader or another platform, that's fine too, but make sure your tools support multiple SMAs with custom colors, drawing Fibonacci retracements, manually mint trendline drawing without auto-snapping. You're in Trading View. Choose a dark or light theme, whichever you can stare at for hours without eye strain. Trust me, comfort matters when you're analyzing markets seriously. Step 2. Choose the right time frame. This strategy works on any time frame, but your setup depends on your trading style. Scalping intraday, 5M, 15M, 30M charts, swing trading, 1H. For H, daily position trading, daily, weekly. For this tutorial, we'll focus on the 1H and 4H time frames, because they strike a balance between noise reduction and enough trade opportunities for most traders. Never mix different time frame setups in one strategy session. Always run this system per time frame, and then use higher time frames to validate trend direction. This is called top-down analysis. Step 3. Add the 3 SMAs. Go to Indicators and search for Moving Average. Add it 3 times, then edit. Each one, 50 SMA. Color it yellow, 100 SMA. Use blue, 200 SMA. Make it red. Make the lines thicker than default, so you can distinguish them easily, especially when 2 are overlapping during a compression zone. These colors aren't just for aesthetics, they create a visual hierarchy. Yellow equals short-term, blue equals mid-term, red equals macro. Think of it like traffic lights. Yellow, caution and setup zone. Red, major reversal or bounce area. Step 4. Fibonacci tool settings. Now, enable your Fibonacci retracement tool. Draw it from the most recent swing low to swing high in an uptrend, or swing high to swing low in a downtrend, closing parenthesis. Go to Settings and customize the levels: 0, 2360.3, 820.50.6, 180.7, 861.01.618. Optional for extensions. Color code these. Make 0.618 golden yellow, 0.382 and 0.786 as gray, 0.5 as white 2s. Dotted lines for all levels. Why? Because the golden zone between 0.5 to 0.618 is your prime hunting ground. Visual cues make you react faster when live trading. Also, check the box for extend lines in your settings, so the fib lines run across the chart and don't disappear on zoom out. Step 5. Draw trend lines the right way. Forget diagonal lines that chase candles. Draw trend lines from major swing low to next higher low in an uptrend, major swing high to next lower high in a downtrend. Your trend line should have at least 2 touches. The third is your validation bounce. Use white or cyan for trend lines, colors that contrast your chart background and don't blend with SMA lines. Keep your trend lines clean. If you're drawing 6 trend lines per chart, you're overcomplicating it. 2 or 3 is more than enough. A great rule: If the line doesn't make a decision easier, delete it. Step 6. Create a chart template now that everything's in place. Save your layout as a template. Name it something like SMA-Fibonacci-Trendline strategy. This makes sure you never start from scratch again and lets you switch charts in seconds. An underrated productivity boost for serious traders. You can even go further and create chart templates by asset class. Forex template, crypto template, stocks template. This allows for specific tweaks based on volatility and average ranges. Step 7. Routine setup before analysis. Every time you sit down to analyze, zoom out to see the bigger structure. Check SMA slope, direction, and compression mark. The most recent swing points. Draw your fib retracement across latest impulse plot. Valid trend lines only after step 4. That's your pre-trade routine. Make it a ritual, not a random mess. Ritual builds consistency, and consistency builds edge. Why setup matters. Most failed trades come from messy charts, not bad strategies. Your chart isn't a canvas for creativity, it's a battle map. Every line, every color, every angle should exist to help you make faster, clearer decisions. With this setup, you'll be able to instantly spot zones of SMA-Fibonacci-Trendline, confluence, avoid overtrading and sideways markets, build confidence through repetition. You're not just looking at charts anymore, you're reading a story about price memory, trend pressure, and market psychology. When you train your eye to see this story clearly, the market starts speaking your language. Now that your chart is locked and loaded, it's time to move on to the first real skill: identifying market structure and trend development. Let's get into the logic behind trends and how to see through fake ones like a pro. Section 4. Identifying market structure. You can't trade trends if you can't see them clearly. This next step is the foundation of all trade decisions in this system. Understanding market structure. Most traders think they know what a trend is, but the truth is, they react to noise, not structure. Let's change that. What is market structure? Market structure is the sequence of highs and lows that form the narrative of price. In a bullish trend, we want to see higher highs HH and higher lows HL. Bearish trend, we want to see lower lows LL and lower highs LH. But here's what separates amateurs from pros. The context of these moves matters more than their labels. You don't just look for higher highs and assume the trend is strong. You look at how price gets there. Was the move impulsive or corrective? Did volume increase or die out? Did price pierce previous highs with strength or with a weak push? These clues help you decide if the trend is strong or on life support. How to identify a swing high and swing low. Swing highs and lows are the anchor points for drawing Fibonacci and trend lines, so spotting them correctly is key. Here's how. A swing high occurs when a candle has a higher high than the candle before and after it. A swing low occurs when a candle has a lower low than the one before and after. But don't just go candle by candle. Zoom out and see the bigger waves in price. You're looking for logical turning points, not micro fluctuations. A good rule of thumb: if you wouldn't notice it on a zoomed out 4H chart, it's probably not a meaningful swing point. Structure versus noise. This is where most traders mess up. Let's say price makes a lower low, but then immediately spikes back above the previous high. Was that a breakdown? No, it was a liquidity trap, a false move designed to trigger stop losses. You must develop the skill of asking, is this structure clean and flowing, or is it spiky and manipulated? Clean trends look like waves, impulse, correction, continuation. Dirty trends look like chaos, sharp moves, huge wicks, and overlapping candles. Only trade when the structure makes sense. If it doesn't, step aside. Remember, uncertainty is a valid signal. Anatomy of a trend. Every trend has 3 parts: impulse leg, the strong move in one direction correction leg, a slower, messier move in the opposite direction continuation or reversal. The impulse tells you where the power is. The correction tells you how healthy the trend is. And the next move tells you what's next. A good correction is usually shallow and controlled. If the correction is too deep, say, more than 78.6% of the move, it often signals a possible reversal. That's why we use Fibonacci levels to measure pullbacks. Common market structure traps expose the three biggest structure traps traders fall into. 1. Micro trend traps. Traders get obsessed with 1-minute or 5-minute highs and lows. That's noise. Without broader structure, these trends collapse fast. Fix. Always zoom out. Check the 1H or 4H chart to validate trend context. 2. Chop zone. Confusion in ranges. Price often creates both HHs and LL scan, fusing the trend reader. This isn't a trend. It's a distribution or accumulation phase. Fix. If you see HHs and LLS within 10 to 20 candles, treat it as a range and wait for a breakout. 3. Broken structure equals trend. N days. Single broken HL or LH doesn't mean trend. Reversal. It could be a deep correction or a fake out. Fix. Confirm with momentum. If the move breaks structure and has strong volume and wide candles, then it's likely a real reversal. Structure-based decision-making. Now here's where the power comes in. Once you've identified a valid trend, use the last impulse leg as your Fibonacci base. Use previous HL or LH to draw trendlinesses, the 50 or 100 SMA, as your trend confirmation filter. Now you're building a confluence zone between trend, structure, and your tools. Let's say price is in a bullish structure, and it pulls back to the 61.8% retracement, touches the ascending trend line, and kisses the 50 SMA. That's a green light setup if the structure leading to it was valid. If structure is clean, confirmation becomes powerful. If structure is sloppy, confirmation becomes a trap. Your edge isn't just in the tools, it's in the interpretation. Most traders blindly apply indicators. You won't. You'll read market structure like a map. You'll know when a trend is healthy, when a move is exhausted, and when to stay out entirely. Structure is your compass. When you align it with SMA slope, Fibonacci zones, and precise trend, you stop being a guesser and become a sniper. And in the next section, we're going to dive deep into SMA zones and how they act as dynamic areas of support, resistance, and hidden liquidity. Section 5. SMA Zones Explained. Simple moving averages are not just lines, they're dynamic zones of power. But most traders treat them like a simple indicator. If price crosses above, buy. If it crosses below, sell. That's not strategy. That's surface level thinking. Let's now break down how to truly read SMA behavior and why SMA zones, not just the line, are the real secret. What is an SMA zone? An SMA is calculated by averaging closing prices over a set number of candles. But price doesn't react to it like a brick wall. Instead, it respects the zone around it. That's why when price taps an SMA and wicks through it slightly, then reverses, that's still a valid reaction. Here's how to create SMA zones. Take the SMA line, say the 50 period, at a small buffer, above and below it like 0.2% to 0.5% of the price treat. That entire band as the zone of interest. Think of it like a magnet. The closer price gets to the SMA zone, the more likely it is to respond, bounce, reject, or pause. 50 SMA Momentum filter. The 50 SMA is your momentum reader. In trending markets, price tends to bounce off this level over and over. If price is above the 50 SMA and the slope is upward, you're in bullish territory. If price pulls back into the zone and holds, look for long entries. But if price closes below the 50 SMA with strong volume and the slope flattens or turns, momentum is shifting. That's your early warning. Pro tip: The 50 SMA is perfect for short-term continuation trades, especially on the 1H2 4H charts. Serrato's SMR transition filter. The 100 SMA is like the trend judge. It doesn't react as fast as the 50, but it gives more stability. Use the 100 SMA to confirm whether a trend is still valid, whether a recent breakout has support underneath, or whether the market is starting to range. One powerful signal is the crossover between the 50 and 100 SMA. If the 50 crosses below the 100 and both slopes turn downward, get ready for a trend shift. Don't trade just on the cross, but use it as confirmation when combined with fib zones and trend line breaks. 200 long-term structure. This is your macro filter. Price doesn't touch the 200 SMA often, but when it does, it's a high-impact zone. In strong uptrends, the 200 SMA acts as deep dynamic support. Think of it like the market's heartbeat. If price holds above the 200 SMA, the bias is bullish. If it breaks below and retests from underneath, we're in reversal territory. The 200 SMA is especially effective on the daily and weekly charts. If price hits a 61.8% fib, lands right on the 200 SMA, and touches that's a triple confluence setup with massive potential. Reading the slope, flat versus steep. The angle of the SMA tells you everything about trend strength. A steep SMA equals strong trend. A flat SMA equals chop or reversal setup. If you see price hugging a flat SMA, be cautious. It's a sign of low conviction. Wait for breakout and slope confirmation. Also, watch for curves. If the 50 SMA goes from flat to upward in a parabolic shape, it often leads strong trend continuation. Compression equals breakout setup. When the 50, 100, and 200 SMA all compress into a narrow band, it means price is coiling. This is often followed by a massive move either up or down. You'll usually see this after long periods of sideways action. Volume dies, range tightens, SMAs flatten, then boom, dash, explosion. Set alerts near these zones and watch for the breakout to align with your fib and trendline levels. How to use SMA zones in confluence here. Where it gets strategic. Let's say price is pulling back. You draw a fib and see 0.618 at $103. 50 a trendline bounce appears at $103. 20 the 50 SMA zone sits between $103.30 $103.60. That's your zone of interest. If a bullish engulfing candle forms there, you now have FIB, confluence trendline reaction. SMA, support price action confirmation. That's your entry signal. You're not trading a line, you're trading a zone backed by logic. Mistakes to avoid. The first SMA touch blindly. Always wait for reaction. Let price prove it wants to bounce, ignoring the slope direction. A bounce on a downward sloping SMA is often a trap. Relying on crossover signals alone, crossovers lag. They confirm, not predict. Mixing SMAs with conflicting messages. If 50 SMA is up, but 200 SMA is flat, be cautious. It's likely a consolidation phase. In the next section, we're going to take your Fibonacci game to the next level. How to use retracements and extensions together, and why most traders misuse the golden zone without realizing it. Section 6. Fibonacci accuracy. Boost. Fibonacci is powerful, but only when used with discipline and precision. Most traders treat fib like a magical bounce tool. Draw from the top to the bottom. Look for 61.8%. Enter. Easy, right? Wrong. Used alone. Fibonacci is dangerous. Used with market structure, SMA zones, and trend lines, it becomes a precision tool. Let's take your Fibonacci game to the next level. What Fibonacci actually measures. Fibonacci retracement isn't predicting the future, it's measuring past moves to identify potential pullback zones. It helps you answer the question, if this trend is going to continue, where might price pull back to before resuming? It's not a guarantee, it's a probability tool based on market memory, psychology, and natural rhythm. The key is using it with precision entry validation, not hope. How to draw fib correctly? Let's clear this up once and for all. In an uptrend, draw from swing low to swing high. In a downtrend, draw from swing high to swing low. Make sure the move is impulsive, fast, and strong, not choppy. You're connecting the real swing points, not minor candle wicks. Common mistake: drawing fibs on tiny corrections or from wicks that aren't significant. That leads to false zones and failed trades. Always ask, would other serious traders draw from this level? If yes, go for it. If no, skip it. Key fib levels to watch. Let's break down the Fibonacci retracement. Levels that actually matter in this system: 38.2%, shallow pullbacks in strong trends. You may not always get an entry here, 0.50%. Technically not a Fibonacci number, but widely respected in institutional trading. 61.8%, the golden zone. This is where most high probability reversals occur. 78.6%, deep retracement, often fakes. Traders out before a strong reversal. Don't treat these levels as lines. Think in zones. We're looking for reaction areas, not precision sniper dots. Combine them with SMA and trendline reactions to validate. Fibonacci extensions equals profit. Zones: most traders stop at retracement, but extensions give you target zones. Here's how to use them. After price retraces to a key fib level and resumes trend, draw an extension from the same swing points. Watch the 1.272, 1.618, and 2.0 levels. These are likely target areas where price may pause or reverse. Use them with previous structure highs, lows, major trendline intersections, SMA resistance levels when price approaches. A 1.618 extension that aligns with a 200 SMA and horizontal resistance. You've got a profit target magnet. How Fibonacci aligns with structure. Here's the magic. Fibonacci only works if structure agrees. If price is pulling back in a clear HHHL sequence, the fib retracement becomes meaningful. But if price breaks structure, creates a lower low, then touches a fib zone, it's a trap. Why? Because the trend is broken. Always pair Fibonacci levels with confirmed structure. Trends: SMA, slope in the direction of the trade. Valid trend lines with multiple touches. You're not trading a number, you're trading a storyline supported by multiple tools. Entry signals at fib zones. Let's say price pulls back to the 61.8% retracement. That's not your entry. You wait. What you're looking for: A candlestick pattern, like a bullish engulfing or pin bar volume confirmation. A trendline bounce within the FIB zone. Semi-slope in your favor. When all of that aligns, you're now entering with confluence and confidence. When Fibonacci fails, it happens. Not every 61.8% bounce works. Here's when to be cautious. When fib lines up in the middle of a chop range, when prices whipsawing across SMAs are flat or invalid, when news volatility breaks technicals, didn't force it. If confluence isn't there, skip it. The next setup is coming. Advanced tip: fib clusters. Want a secret pro level trick? Look for Fibonacci clusters when two or more fib levels from different moves overlap. Example: draw fib from last impulse up, draw fib from a higher time frame swing. If two levels line up like the 61.8% on 1H and 50% on 4H, you've got a stacked zone. Market. Wait for reaction. These clusters often create major pivots. Mistakes to avoid: drawing fib without a clear impulse gives. Always start from strong, fast moves. Ignoring structure gives. If trend is broken, fib zones are meaningless. Using fib levels as exact entries gives. Always wait for confirmation from price action or trendline SMA. Confluence: neglecting the full zone gives. Don't treat 61.8% as a pixel perfect level. Think of it as a band, not a line. In the next section, we're finally going to bring everything together by breaking down how to draw clean, reliable trend lines and how they complete the SMA Fibonacci trifecta. Section 7, Drawing Clean Trendlines. Trendlines are the most overused and most misunderstood tool on any chart. Everyone draws them. Few draw them correctly. Used right, trendlines give you context, momentum, and powerful entry or breakout signals. Used wrong, they give you fake setups, confusion, and losses. This section is all about mastering clean trendlines and how they complete the SMA-Fibonacci trifecta. What is a valid trendline? A trendline connects two or more price points to represent the direction of the trend, but that doesn't mean you can draw it anywhere. Here are the rules. Use at least two clear swing points. The third touch confirms it. In an uptrend, connect swing lows, higher lows. In a downtrend, connect swing highs, lower highs. Do not cut through. Major candles or wick trendlines must be obvious, not forced. If it's not clean, it's not valid. Think of trendlines as visual storytelling. If it doesn't tell a clear story, don't use it. Dynamic trendlines versus static levels. A common mistake is treating trendlines like horizontal support, resistance levels. But trendlines are dynamic, they move with time. This means you need to revalidate them as new swing points form. Don't just leave old lines on your chart, update them, watch how price interacts. If price breaks a trend line, but comes back and respects it from the other side, that's real confirmation. The three-touch rule: you only act after the third touch. Here's why. First touch, you're just observing. Second touch, a possible setup is forming. Third touch, confirmation. Now it's a valid trend line. Once the third touch holds, you've got a reactive line. Look for entries at the bounce breakout setups. If price pierces it with force, never trade a trend line that only has one touch. It's not a trend, it's a guess. Trendline breakout traps. This is where traders lose money. You draw a trend line, price breaks it, and you jump in, but then it reverses right back. Why? Because you traded the first breakout without confirmation. Here's the better way. Wait for the break, wait for the retest, enter. Only when price rejects or confirms that retest, also check volume. A breakout without increased volume is often a fake. Steep versus shallow trendliness. Angle of your trendline tells you about momentum. Steep trendline, aggressive move, likely to break soon. Shallow trendline, sustainable move. More reliably if your trendline is at a 60 to 75 angle. Be cautious, it's likely an exhaustion move. Expect a sharp correction. If it's between 20 to 45, that's a healthy trend. These lines hold longer and give cleaner bounce entries. Trend lines as context, not just entry. Trend lines aren't just for entries. They tell you the momentum of the market, the potential exhaustion zones, when a trend might be ending. For example, if price is above all SMAs, holding above a shallow trend line, and bouncing at the Fib golden zone, you're looking at a perfect storm of confluence. Even if you don't use the trend line as your entry, it reinforces your conviction. Internal versus external trendlines. Extra trend lines, drawn from major highs, lows, clear, and visibly. Internal trend lines connect smaller swing points within a structure. Use internal lines to track micro trends during corrections. External lines show the overall structure. Example, during a pullback to a 61.8% Fib, draw an internal trend line across the minor lower highs. If price breaks that internal line with momentum, it signals the end of correction and resumption of the main trend. This layered view gives you early entry confirmation. Combining trend lines with SMA and Fibonacci, this is where it gets powerful. Let's say price is pulling back in an uptrend. You draw a Fib from the last impulse low to high. The 61.8% level sits at $1. 0850, your 50 SMA zone is around $1. 0870, you draw a trend line through two swing lows, and the third touch hits right at the same zone. Now add price action. A bullish engulfing candle forms at that level. What do you have? Trendline bounce, Fib reaction, SMA support, price action confirmation. That's a 4-point confluence setup. High probability. Clean logic. Common mistakes: drawing trend lines through candle bodies gives. Always respect the wick or body based on where the most touches. Occur chasing trend lines that fit your bias gives if you're forcing a line to fit your narrative. Delete it. Trading the break without retest gives always wait for a reaction after the break. Confirmation over prediction cluttered charts gives more lines equals more confusion. 2 trend lines are enough. Clean chart equals clear minded. The next section will unlock the most important part of this entire strategy: how to execute the actual entry when all 3 tools align. Section 8. Entry Strategy. Combo. Rule number 1. Never enter on the tool alone. We don't trade a fib level. We don't trade an SMA touch. We don't trade a trendline bounce. We trade the convergence of these tools plus price confirmation. Entry should only happen when you see at least 3 of these 4. A key Fibonacci level, preferably 50% to 61.8% price interaction with a dynamic SMA zone 50, 100, or 200. A clean trendline touch or break. Retest A. Clear candlestick signal more confluence equals more confidence equals better entries. Types of entries with setup examples. Let's break down the entry triggers you're looking for. 1. Bounce entry when to use. During a pullback in a healthy trend setup, price pulls into the FIB golden zone hits. The 50 or 100 SMA third trend line. Touch forms a bullish engulfing or hammer enter on candle close SL. Just below swing low TP. 1. 272 or 1.618 fib. Extension 2. Break and retest entry when to use. After price breaks a trend line or SMA from consolidation setup, price breaks trend line pulls. Back to retest same line fib. Aligns near the retest candle prints inverted hammer or inside. Bar breakout enter on confirmation candle SL. Just beyond trendline break zone. TP. Next structure high or fib. Extension 3. Compression squeeze entry when to use. During SMA compression and low volatility setup. 50, 100, 200 SMA. Narrow into a tight zone fib retracement and trend line. Also converge mole-bodied candles forming inside range breakout candle. Closes outside consolidation. With volume enter on breakout candle SL. Below compression zone TP. 2x risk or structural level. Candlestick confirmations. The entry candle must show intent. Not all green candles are entries. Best signals. Bullish engulfing, bearish engulfing pin bars, long wicks. Inside bar plus breakout morning evening star breakout candle with above average. Volume avoid doji candles with no body, small indecisive candles. Into nearby resistance. The candle tells you who's in control. Don't fight the candle. Risk management on entry. Every setup needs proper position sizing and SL logic. No exceptions. Here's how. Define your SL based on swing, low, high, or ATR. Define your TP fib extension or next major level. Choose a minimum risk. Reward equals 1 to 2. Never risk more than 1 to 2% of your account on a single trade. Use a calculator. Guessing size is not strategy. If your RR is below 1 to 2, skip the trade. High win rate setups should still pay off big when they land. Filtering bad setups. Not every triple confluence is tradeworthy. Here's your checklist. To filter noise. Is structure valid? Is SMA slope aligned with trend? Is the FIB drawn on a real impulse leg? Is the trend line clean, not forced? Is the candle strong and decisive? If the answer is no to any of these, don't enter. You want clarity, not confusion. Bonus tip, set alerts at your ideal zone and walk away. Let the market come to you. No more revenge trades or FOMO. Real world example, verbal walkthrough. Let's break it down. You're on the 4H, your USD chart. Price is in a bullish trend. Just made a higher high. You draw a fib from swing low to high. 61.8% is at 1.0850. The 50 SMA sits at 1.0860. Trend line from the last 2 swing lows lands at 1.0855. Price touches all 3 and forms a bullish engulfing candle. Volume spikes. On the close you enter long SL1 835.15 pips below the swing tepi. 10,950. 1.272 fib extension. That's a textbook entry. No guessing. No stress. Mistakes to avoid entering on fib alone. Gives fib as a zone. Not a trigger. Ignoring candle behavior gives entering on indecision. Equals asking for a loss. Skipping the checklist gives confluence is cumulative. Never enter on one tool alone. Moving SL too early gives let the trade breathe. Protecting too soon kills good setups. Trading counter-trend setups without clear reversal gives. Wait for trend breaks and structure shifts before flipping direction next. We'll break down how to protect your capital and grow it with stop loss, trade management, and risk to reward techniques used by professionals. Section 9. Stop loss and risk management. Winning trades feel great. But if one bad trade wipes out 5 good ones, you're not a trader. You're a gambler. In this section, we'll focus on the most overlooked part of trading: stop loss placement and risk management. This is where you protect your edge and build longevity. What a stop loss is on. A stop loss is not an admission of failure. It's a risk control mechanism, a limit, and a plan B that you hope you don't need. But when it's placed, well, it allows you to trade freely and confidently, knowing your downside is defined. It's not a round number. It's not a guess. It's not where you'd prefer to get out. It's where the trade idea is invalidated. How to place a smart SL. Here are 3 methods we use in this system. 1. Structure-based stop place. Your stop. Below swing low in long trades, above swing high in short trades. Why? Because if price breaks that swing, the structure is broken and the setup is no longer valid. This is the most reliable type of SL in a confluence strategy. 2. ATR based. Stop. ATR equals average true range. This tells you how much price normally moves. Use 1.5x ATR from your entry for volatile pairs like crypto 1x, ATR for 4x, and less volatile. ASSETS example. ATR equals 25 pips on your USDSL equals 37 to 40 pips. From entry, this accounts for normal noise, news, and minor spikes. 3. Trendline or SMA-based stop. Place your SL just beyond the trendline or SMA zone if it's a key element of the setup. If your trendline breaks, the trade thesis changes. That's your exit. Use this only when your trendline or SMA zone is sharply defined and well respected. Bad stop loss habits. Too tight gives stops that don't let the trade breathe. Get hit even if the trade was right. Too loose gives stops that risk 5% plus of your capital. Destroy your account over time. Emotionally placed gives it just feels right here. No logic, guawa. No longevity, no stop at all gives you're not a trader. You're praying. That's not a system. Take profit strategy. Now, let's talk targets. Because exiting too early is just as bad as no SL. Here's how to do it with this system. Primary TP methods. Fib extensions. Use 1.272 and 1.618 as TP1 and TP2 structure levels. Use last major high, low as a base target. Round numbers. $2, $10.00, 1.1000, etc. These act as psychological magnets. TP management. Scale out at TP1, 50%. Move SL2, break even, let the rest run to TP2. This lets you lock profit, reduce emotion, and give room for larger wins. The 1 to 2 rule. If your stop loss is 30 pips, your minimum TP should be 60 pips. This is your risk to reward ratio, RRR, why it matters, even if you only win 40% of your trades. With 1-2 RRR, you're still consistently profitable. Most losing traders actually win more often, but their RRR is too low. You're not just trading setups, you're trading math. Trade management scenarios. Let's apply SL and TP logic to 2 examples. Example 1. Long setup entry, 1.0850. SL. 1.0820 below swing low TP1, 1.0900 structure high, TP2, 1.0950 fib 1. 272 extension trade plan. Risk equals 30 pips TP1 equals plus 50. Pips TP2 equals plus 100 pips move SL2, break even at TP1. Let TP2 hit or trail with SMA. Example 2, short setup entry, $29,800 BTC SL dollar, $30,150 above trendline plus structure. TP1, $29,000 fib 1.27 to TP2, $28,300 structure support trade plan. Risk equals $350, TP1 equals plus $800, TP2 equals plus $1,500 scale out 50%. At TP1, let TP2 ride capital protection plan. No single trade should put your account at risk. Follow these principles. Risk 1 to 2% max per trade avoid. Overlapping trades with correlated pairs never trade. If you don't know where your SL and TP are trading is not just about entry, it's about managing the outcome. Bonus, trail your stop once, you're in profit. Move SL to break even at TP1 use the 50 SMA or internal trend line as a trailing guide lock. In gains, as price creates new structure, never trail too tightly. Let the trade work. Your goal is to maximize reward, not just minimize loss. Next, we'll learn how to manage and scale trades like a professional, turning one winning idea into 2 or 3 entries with clarity and confidence. Section 10. Trade management and scaling. Placing a trade is just the beginning. The real work begins after you're in the market. What you do with an open position determines whether a winning trade becomes great or turns into regret. In this section, you'll learn how to manage trades actively, scale entries like a sniper, and protect your profits with intention. Why trade management matters. Trade management is about reacting to the market in real time while sticking to the core plan. Great setups can go wrong. Mediocre ones can turn into gold, but only if you know when to add, hold, reduce, or close without emotion. The difference between a 20% year and a 200% year, it's not more trades. It's better management of the best ones. Building a trade scaling framework. Let us break down the 3 types of scaling you'll use in this system. 1. Scaling in. Pyramiding winners used to add to a winning trade when conditions remain favorable. Example, you buy at 1.0850 and it moves to 1.0880. A new fib retracement forms and price pulls to the 38.2%. You get another engulfing candle above the 50. SMU enter against same direction. This lets you compound your gains in real time. Rule: only scale in if your SL can remain logical and overall risk stays under 2 to 3% combined. 2. Scaling out. Locking gains. This is how you protect profits without closing the full trade. Best method. Take off 50% at TP1, move SL2, break even, let the rest run to TP2 or trail behind the 50 SMA. This reduces stress and eliminates emotional decision making. Even if the rest hits SLEU, banked profit and protected capital. 3. Re-entry. Getting back in with structure. Sometimes price hits TP1, retraces and sets up again with new confluence. Example, price hits fib, extension plus structure zone, pulls back. You draw a new fib and see a fresh golden zone at a higher low trend line still intact. SMA slope strong. You now have a second chance to re-enter the trend with the same tools. Just treat it like a new trade with its own SLTP and structure. How to adjust risk during scaling. Scaling or re-entry must obey position sizing rules. Never exceed 2% total account risk. If scaling in, reduce new position size. 2. Maintain total risk tolerance. Use smaller lots for add-ons. Don't double down blindly. Your goal isn't to get rich on one move. It's to let great trades pay off more without blowing up your account. When to move your SL. Here's the smart progression. Initial SL at structure low, high when entering after TP1 hit. Move SL2, break even as price forms higher highs, lows. Trail SL behind new swings, or SMA's final SL. Tighten aggressively near. Scale out 50%, move SL2, 1.0850. Break-even price pulls back to 1.0870. Holds above 50 SMA prints hammer entry to scale in at 1.0875. New SL equals 1.0855 tight swing low TP equals 1.950 again, TP2 hits. Total win equals double position profit, plus reduced risk. You just turned one trade idea into 2 profit streams with no extra guessing. Mistakes in trade management adding to losers. Martingale gives never scale into a losing trade. That's how accounts die. Scaling in without structure gives your compounding risk, not edge. Trailing too early gives let the trade develop. Break even too soon equals SL hit for no reason. Skipping TP1 exit gives you lose all control when you don't bank partials. No re-entry mindset gives great trades often offer a second chance. If you're watching with structure, when to let the trade run. Some trades deserve space. When all 3 tools align with strong slope and trend volume spikes in your direction. No major resistance or reversal zones ahead in these cases. Consider trailing your SL wider below the 100 SMA or recent trend line. Let the market give you more than you expected. Remember, one outlier trade can account for 30 to 40% of your annual P&L. Don't cap your winners. Just protect your edge. Now that you can enter, protect, and scale a position, it's time to wrap it all up with the exact rules and blueprint to trade this system from A to Z. Next, the full SMA Fib Trendline strategy checklist. Section 11, Strategy Blueprint and Checklist. You've learned the tools. You've seen the setups. You've mastered entries, SL scaling, and trade psychology. Now it's time to bring it all together into one step-by-step checklist that you can follow on every single trade. This is your SMA Fibonacci-Trendline blueprint. Treat it like a pilot's pre-flight checklist. Run it before every entry and watch your consistency rise. Step 1. Identify the market structure. Ask, is the market in a clear trend or range? Are we seeing HH and HL bullish, or LL and LH bearish? Has a recent structure point been broken? Use the 4H and 1H charts to determine the main trend. Avoid entries in tight ranges or chop zones. Confirm at least 3 structural swings in the same direction. If structure is unclear, wait. No structure equals no trade. Step 2. Apply the SMA filters. Overlay your 50, 100, and 200 SMAs. Check, is the slope aligned with the trend? Is price respecting the SMA as dynamic support, resistance? Are multiple SMAs compressing or clearly spread? If price is above a rising 50/100s, SMA equals bullish territory. If price is below a falling 50/100s, SMA equals bearish zone. Bonus, SMA compression means potential breakout setup. Wait for alignment and volume spike. Step 3. Draw the trend line. Use recent swing points. In uptrend, connect higher. Lows in downtrend, connect lower. Highs validate at least 2 touches. Preferably get a 3rd touch confirmation. Trendline doesn't cut through major bodies or wicks. Mark internal and external trend lines. Internal equals 4, micro timing. External equals 4, structure confirmation. This sets up your zone of reaction. Step 4. Pull the Fibonacci draw from swing low to high, uptrend swing, high to low downtrend. Make sure the move is impulsive and clean. Fib levels 50%, 61.8%, 78.6%, land near trendline or SMA zones. Look for confluence. When a Fib golden zone overlaps an SMA and trendline, that's a hot zone. Step 5. Wait for price to enter the zone. Set alerts at SMA. Fib 50 to 61.8% zone SMA reaction. Zone's trendline bounce area now. Wait. Let price come to you. Watch for volume spikes or wick rejections. Be patient. This is the pre-launch moment. No touch equals no trade. Step 6. Confirm. With candlestick pattern only, take the trade when a strong candle forms. At the zone. Best confirmations. Bullish, bearish, engulfing pin bar, with long wick inside bar plus. Breakout morning or evening startant, enter on. Weak doji candles inside chop no volume. Let the candles speak clearly. STEP7. Define SL and TPSL must be below swing low for longs or above swing high for shorts, or beyond trendline. SMA zone or 1.5x ATR-TP must be. Fib extensions 1.272, 1.618. Major structure levels round numbers optional. Minimum RRR equals 1 to 2. Calculate lot size based on your account. Risk max 2%. Step 8. Manage the trade once in. Move SL to break even at TP1 scale, out 50% at first. TP zone trail SL, behind structure, or the 50 SM consider re-entries, if structure remains valid scaling, in if new fib, trendline zones form exiting. Early if momentum dies or candles turn against you stay structured, not reactive. Step 9. Journal the trade after each trade. Log entry, reason confluences, used candle confirmation, used where SL and TP were placed, whether SL moved on time, what you could improve. This turns every trade into data. Over 50 trades. This journal becomes your personal trading edge amplifier. Step 10. Stick to the strategy. This strategy works because it's simple and rule-based. You'll be tempted to skip structure enter without candles move. SL2, Sunad, without logic dent. The system works when you follow it 100%. Great traders don't have magic. They have discipline. You now have everything. The indicators, the tools, the exact entry rules, the scaling tactics, and a full strategy checklist to trade with confidence. But here's the truth. Information without action is useless. So here's your challenge. Pull up a clean chart, apply the SMA Fibonacci-Trendline framework, test it, backtest it, journal it. Watch what happens when you trade with logic, not emotions. If this course helped you level up your trading, don't keep it to yourself. Like this video, subscribe for more advanced trading strategies. Drop a comment if you've got questions or results to Shirai. Read every one. This isn't the end, it's the beginning of trading with real confidence. Thanks for watching.